If you've ever had trouble identifying reversal patterns, try the MACD Divergence. The MACD Divergence comes with two studies, a lower study where the outside line highlights the moving average divergent signals, and the inside line shows the histogram divergence. The second MACD Divergence Indicator shows an upper study on your candlestick charts. Because they're two studies showing you the same thing, I'm going to remove the lower study so we can focus in on the charts. MACD Divergence is fantastic at finding double tops. This double top resulted in a massive sell-off. It also works on broadening patterns as price action kept going up, setting up for a massive sell-off. Depending on the way you see it, this MACD divergence signaled two patterns. One, a three drives method, which came right back down to support. The other time it alerted us of a head and shoulders pattern, where price action broke the neckline and went lower. These MACD divergence patterns happen all the time. Big run up leading into big sell-offs. Welcome to Stock Charts Trading Indicator Alerts, where we go over all of the indicators and give you a weekly review of the trade setups and how to make money in the weeks ahead. If you want to use the MACD indicator for yourself, then go to stockchartstrading.com to get yours today. Now let's dive a little bit deeper into how the MACD divergence can help you. First thing I like to do is look at the broader market to see what direction the trend is. In this case, we can see that the stock market is selling off. We can also see that currently we have a MACD divergence up against stock trend resistance, which should give us a nice sell-off back down to the support level, making a double bottom, or by duplicating the bear flagpole, could give us a lower support level of $300. Now that we know there's a high likelihood of the broader market selling off, we should only be looking at bearish divergence. So when looking at the SPY, we can see that it already sold off from its highs. So if we were able to find double top formations, we would have a high likelihood that those stocks would sell off with the rest of the market, making a very good profit. And if we were to find the same setup as a triple top, that would be even better, confirming the resistance line, given a higher probability of a sell-off. The nice thing about both these trade setups is range box duplication. The stock will typically break lower, duplicating the range box, giving you lots of profit. On WM Waste Management, we can see there was a triple top pattern here, and price sold all the way back off to support. And now we can see 1, 2, 3 MACD divergence signals, giving us a bigger triple top, with today's candlestick selling off, confirming this is a good resistance line. For those who understand the Elliott wave, we also have a completion pattern up against this resistance level. If you'd like to know more, click in the link above. And the great thing about this pattern setup is you've already got a defined support level of $140 and anticipation of where to take your profits. Like I said before, if you're a patient trader, you can make a range box off of this pattern formation, take some of your profits back down here to support. After a little retracement higher, price action will break lower, going down to the next range box, which will probably come around this $110 level. The way I would do this is to take all of this move here over 200 days to give a long-term expiration date on your options. This is a very high probability because remember, the SPY is already 20% off of its highs, which would put this ticker down around $135. UNH 2-year 2-day again looks drastically different than the SPY. This chart's going up where the broader market's going down. The reason I'm using a 2-year chart here is to show you that we are at extreme highs. Now when you go down to a 1-year 1-day chart, you can see there's lots of divergence showing a heavy topping pattern, maybe even a head and shoulders pattern, but just focusing in on the last two divergence, making a double top with a little bit of a sell-off, proving that this is a good resistance level, but still in the upward channel, lets me know there's a high probability this is going to come back down to the support level of $450. Back out on a 2-year chart, if this came back down to support and broke that level of support, it'd give a lower level of $360 target. Of course, this could take some time, so be mindful of the options that you use. McDonald's 2 years 1 day, we can see that we're still in a strong bull trend, but lowering it down to a 1-year chart using the MACD divergence, you can see a double top formation. You might want to wait until price action comes back into this $270 level before selling off back down to support. You can use $250, $230, even $225 as targets. Hershey 1 year 1 day, yes, it's in an uptrend, and technically this is a counter trend trade, but knowing so many stocks have already sold off 20 to 70% and Hershey's is still at an all-time high, it makes me think that the broader market is the leader and Hershey's will catch up by selling off lower. Taking this MACD and this MACD divergence, drawing a line across, gives us a perfect double top. With this double top, you can see that it touched 3 times before selling off. So there is a likelihood that price action could come back up into this resistance resistance level before selling off to the support. I would use this $200 level as my first target on a longer term trade setup. On a really long term trade setup, this $175 target is a major support level. Great place to take profits. Dollar Tree all-time highs, but notice what's happening with the stock trend indicator going sideways, letting us know that the momentum has stalled. Using this double top formation with the bearish divergence seems like a smart trade setup. If we took the trade down to this $125 support level, that would give us over 20% profit. This was a pretty big move down to this support level, but it also was because of earnings. But that gives it an estimate of 45 days. Maybe if we doubled it out to 80 days, putting us at November. From this gap level, we could see strong support, giving us a strong indication that price will go lower. Now, this might be the best trade setup for double top. We could see that we were in an uptrend, but recently the stock trend indicator is starting to point down, making this price action up against resistance a phenomenal point to sell off, back down to these lower levels of $195. Of course, your eye's probably already been drawn into the first resistance level, bringing that over, making our double top formation. Bringing in the bear flag indicator, you can see it's making a perfect W pattern up into resistance, with price action at resistance in the red zone, making a double top, and implied volatility being extremely low in the red zone also lets me know that this will be a great place. As price action falls off, implied volatility will go up, making my put options very valuable. To consider what expiration to use, I'm going to duplicate this price pattern over and make a range box on time and price. This says 85 days we will need at minimal for our option. But the sell-off was pretty significant at 25%, almost $56. Duplicating this over makes it obvious that this will be the same price action movement, putting the expiration date at late October. I think to be cautious, let's also look at November to see if there's much difference in the valuations. On ADP, we can see that there's no October expiration chain yet, which makes it perfect for us to pick October. With the last price being $245, make sure you're set on single options. Go down to the strike price that closest represents the current stock price. From there, I like to use volume and open interest. Once I find the current stock price, I look for the next area with the biggest amount of volume. Current stock price, 154. Next one, 96. That's less. That doesn't mean I should buy that one. Next one is 282, which is pretty average with these other strike prices. But for me, this is the significant number of 821, giving a 4 times increase to this number. Going back down to the support level of $200 makes a move of $45 sell-off and a 19% lower in price action. If you were to use your theoretical pricing, taking you to the expiration date and the estimated move, you could also see which option yields you more profit. And in this case, you'd yield about 300% profit using the lower strike price. The higher strike price would yield you almost 400% profit. Bigger profit, bigger probabilities. Looking at NOC 2-year 1 day, we can see it's in a huge uptrend near all-time highs with a divergence pattern. Lots of resistance across this triple top, and price actions currently selling off. Depending on your trade strategy, you might want to wait for a little bit of a retracement before getting into this trade lower. My first support target would be down to $430 from the highs to the lows. Duplicating that would put it all the way down to $375 for support level target. On is on fire, still in a strong bull trend, making all-time highs up in this resistance area. This might be considered a Wyckoff distribution reversal because of this impulse wave right here. Then having this plateau area of 4 different times it's touched makes very heavy resistance. With a support of $45 makes this a pretty big move. You know the saying, old resistance, new support, support, support. With this trade being over 32%, I think you could yield enough that you wouldn't have to consider a lower profit target. Pepsi in a 2-year uptrend, making a triple top, showing heavy resistance with a MACD Divergence Indicator, giving a support target around $155 is only a 10% move lower. I'd definitely consider doing a range box duplication down to this $130 level, giving you the ability to take some profits, not just once, but twice. Last one we're looking at is Costco 2-year 2-day. We can see a heavy uptrend, but with this big sell-off, we can see the retracement only came back up into this head and shoulders formation, giving a high likelihood we're going to come back down and test this $440 level. I did talk about this trade 2 years ago when it was right here. Then the price action moved up another 5%. And that's why you have to make sure you have enough time of expiration on these options, or use option strategies like vertical spreads that draw a line in the sand for you, so that when price action goes up and down, making a double top before selling off, you have plenty of time on your option expiration. To show you a bear put vertical spread, we're going to zoom in to Costco 1-year 1 one day. We have all the parameters up against resistance, MACD divergence, bear flag making a wedge, giving us a great signal that price action is going to sell off lower. Of course, we have this last move down. When price breaks out, we should get that same duplication move lower. As we can see, the typical formation as price action goes higher, implied volatility goes lower, giving us a very low cost to buy puts. And the even better thing is, last time Costco came into earnings, the implied volatility went up, which gives us another confirmation, the high likelihood that implied volatility of our puts will also go up as the price action comes lower. So since I know this is a head and shoulders pattern with lots of resistance right around this price range of $335, I'm going to buy an October vertical spread, giving me plenty of time to hopefully get the same results as we did back here. When you do this, go to your option chain and make sure you're on vertical spreads. Or if you know how to, you can leg in one at a time. Pick the October expiration. As you can see, I've already entered into this trade for September expiration a couple weeks ago. Like we said earlier, Costco's around $335. So that's the strike price I'm going to look at, which is right here, $535 spread to $540. For this, instead of using volume or open interest, I typically look at ROR, which is return on risk, or ROC, which is return on capital. It's great because it gives you a quick analysis of how much you'll return based off this current trade setup. In this case, because it's 106, means you would only make 95% of return on your money. Because this one's 85, it means you'll make 115% return on your money. I like those odds better, especially because it's at the strike price. Because the option values are low, that means I'm going to buy using the ask side of the option chain. To confirm, it will show up green. In this case, you want to make sure that you're always at the midpoint, which is the lowest amount of value, because your option is going to increase in implied volatility value. A way to check that is just confirm that your max loss is lower than your max reward. If you want to analyze the option value on your charts, click here, and here's the option graph setup. Currently, if price action stays under where you are right now, you'll make 115% profit. If price action is above that resistance line, you'll lose $2,500. And here's the visual of that. Price action has to stay below this high right here by expiration of October 21st. But based on the probability of the divergence showing heavy sell-offs, we should anticipate that here. Based on implied volatility wedges, in the past we've seen major sell-offs, so we should anticipate that here. Or of course, you can do a naked put because implied volatility is so low, back down to this support level, making a move of $120. Make sure you're on single options. If the price action moved down $115 by the October expiration, the at-the-money put options would yield you 460% profit. That's pretty good results. I hope the MACD indicators really help you kind of get the insight of how to make reversal trades. When you see things up against resistance with the MACD indicator, how to analyze chart patterns so that you can properly trade them lower and make lots of money. Whether you use the vertical spread or the put options, just make sure you analyze the risk to reward ratio. Give yourself plenty of time. As always, I wish you the best in trading.